Today, folks, can you believe that we are 3 percentage points from all-time highs in the Canadian market, and over the last year outpacing the SP 500 on the back of a tariff war where the US has huge leverage over us. We just got through an election. Our Canadian dollar has cratered and there's recession fears at every angle. Red flags popping up. Yet here we are at all-time highs. But the data indicates right now that the Canadian markets are actually overvalued and more expensive than the SP 500. And I am just a finfluencer clown on the internet, a squirrel looking for a nut that continues to cost average into these markets regardless of valuations. But the data nonetheless is fascinating to look at. So if you are on a path to financial independence, if you damn well one day want to retire early, join me on that journey. Hit that subscribe button, folks, because the markets are rallying after the election, but there wasn't really an election play. I guess you could have said pipelines might have been a good buy if Polyev won because he wanted to loosen some of the regulation there. And I think Brookfield was a company that obviously Carney worked for, but still those stocks aren't really like ballooning by any metric. It wasn't as volatile as the US election, but here we sit with the S&P 500 up 8.73% over the last year and down 5% year to date, comparable to VCE, which is the exact same ETF, market cap weighted, Canada's largest companies, which we have far fewer of, only 60. And this thing year to date is actually almost up 1 percentage point, and over the last year 14%, outpacing the S&P 500 by several percentage points, which is quite mind-boggling if you also tap in the dividend that hovers around 3% for this ETF. But what gets fascinating to me is when we dive a bit deeper into the data itself. But before I kind of just do the quick valuation comparables, I do want to point out the dividend ETF that I primarily love, the only real exposure I have to the Canadian markets, is VDY. I like the upper weighted exposure to the Canadian financial institutions, though we're going to see they're kind of overvalued. They have been a place of resilience through market volatility, which is why I like getting some upper weighting there through this ETF. But even this ETF's up 12%. With the extra dividends that you're getting, it actually is almost in line with VCE, but year to date, the stock is roughly flat. But nonetheless, so let's get into valuations in 3 of these ETFs to get an idea of growth, what it might look like in the current market environment. So again, these are hard one-to-one comparables. So the only thing we can really look at is the price to earnings. I want you to pay close attention to, and the earnings growth and the return on equity, because the S&P, regardless if you think it's overvalued or not, the past performance has been astounding with the earnings growth rate at 19%, a 25 times multiple, probably lower because this is based off March 31st, not into the end of April here, and price to book 4.6, equity 27%. If we do the quick comparable to VCE, we scroll past those top 10 holdings there, which if you wanted to see the top 10 holdings in the Canadian markets, it's basically Royal Bank, Shopify, Toronto Dominion, Enbridge, Brookfield, Bank of Montreal, Canadian Pacific, mostly banks, some railways, a lot of energy in here. You can see energy makes up 18% of the economy here, or in this ETF, 39%, almost 40 financials, and then about technology at 11%. Definitely a lot different than how the US markets look. But what I want you to pay close attention to, again, the price to earnings sits at 20.5 times. That is pretty high considering the earnings growth rate has only been 5.7%. That is really not far away from the US markets, but a quarter less the growth rate, with return on equity at about 11.9%, and the price to book is much more reasonable at 2.2. So you'll notice that the Canadian markets seem to trade more off the equity value of these assets rather than the actual earnings growth, which I just find utterly fascinating because a lot of people run to earnings growth as an end-all be-all. But again, if you look at that price to book at 2.2 times, if we look at the price to book in the US markets, it's 4.6 times. So comparably, the performance rates of these ETFs I just find utterly fascinating and comparable. If we look at VDY, the growth rate for the Canadian dividend stocks right now have been abysmal, and I think that's mostly because of the energy sector over the last year has been depleting quite a bit. We've obviously seen oil sell off dramatically, not some of the oil stocks, but the oil price itself has come down quite a bit, which I appreciate the pumps, but it is hurting the earnings growth of a lot of these Canadian dividend ETFs at 3.4%. However, the price to book, again, is what I think a lot of these ETFs are trading off of, is only 1.7, considerably low, but the price to earnings on this one is 15.6, which is a lot lower, a quarter lower than even that of VCE. So I find it really neat to see how cratered the earnings have been as of recently in the Canadian economy. We can see a lot of the growth that has been driving here has been coming from companies like Enbridge, some of the pipelines, in the Canadian markets, the banks and the financial institutions on the back of higher interest rates, which I'm slightly concerned for because interest rates have come down a lot. So we need to see if Manulife and a lot of these cash-rich companies like the banks can keep up the net interest income they were able to collect. Right now, Shopify, Constellation Software, our tech stocks are starting to be resilient. Again, their earnings are starting to come back up. So there's a lot of growth in that sector. We've seen consumer goods be on an utter tear. I've talked about this with, some of these companies like Lowe's. The Dollarama's in here. Loblaws. I think when you're talking about consumer goods, not Lowe's. I think is Lowe's a U.S. company next to Home Depot, but we got Waste Connection in here. So a lot of the industrials have been doing pretty well with the exception of the railways. And this is a 1 year kind of look at the market. So let's just break it down by stock to see what the valuations look like comparable to past performance. Because Royal Bank, being the largest company in Canada, has been one of the best stocks you possibly could have bought over 5 years, doubling your money. Great dividend growth. And it is trading down a little bit, giving you some perhaps dip buying opportunities, but even with this dip, I'm shocked to say that Royal Bank is actually trading at a higher price to earnings than it has traded at historically. I mean, if you look at the entire history of this is actually the highest valuation this company has had, whereas it typically trades anywhere from maybe an 8 to a 10, and at the premiums it was trading at closer to a 12, where we saw some price corrections. But yeah, this is quite peculiar for these markets. Same with TD, a company that no one really has been talking about lately, but has been trading at, basically year-to-date highs, up 14%, one of the best stocks you could have bought this year, and it's trading at an 18 times valuation today, which if we see their earnings have cratered and the valuation is trading at highs we haven't seen out through the entire history of TD, probably because of one-off expenses, hopefully when it comes to fines. They have been dealing a lot with some of this legal battle that really kind of brought their stock down with money laundering and all the stuff going on in the United States, especially with the asset lock that's going on in the U.S. A lot of concerns here. So we need to see if this is some temporary earnings drop and if they can recover in the upcoming earnings. And if they can, I think we could see a stock price recovery. But right now, for the value we're getting, it is actually quite an expensive bank. If we look at Enbridge, and this is in line by market valuation, by the way, Enbridge here, trading at a 27 times multiple, we'll find out that this actually isn't too extreme for Enbridge. Actually, there's been times where it's been trading at almost 40 times multiple as its earnings fluctuate, probably more in line with some of the oil prices, but because it is a pipeline company, it's a bit more cushioned and comparable to say something like, which we'll see with Canadian Natural Resources. So it's not uncommon for this thing to fluctuate quite greatly depending on what those earnings are doing over time and maybe some of the infrastructure costs. But yeah, its stock price has been resilient because they did an acquisition similar to what Royal Bank did. This company acquired a U.S. natural gas utility. Royal Bank purchased the Canadian counterpart of HSBC. These mega cap companies have done a resilient job at adding to their bottom line through acquisitions, which a lot of people don't like because companies like Enbridge did dilution to pull this off, but it worked out quite favorably to their stock price, which might come back into that growth that we see from like return on equity or price to book, because their book values will probably be going up on those asset increases. But if we look at Shopify, again, Shopify is actually trading down 11.6%. A lot of people I've been arguing with have been debating on, it started to regain some of the loss. It was in a bubble back here. It was very expensive and couldn't really justify its value, dropping a crazy 80%. But what a great buying opportunity is. It's starting to prove out some of the value more recently and is recovering. We can see that their earnings have started to come back, so we can't really justify its price to earnings multiple because it's had few periods in its life where it actually had earnings, and when it has had earnings, it's always traded at 50 to 60 times multiple, right? So the only thing you can really justify this off perhaps is revenue growth, and the revenue has been trading at the 20 to 30 times growth rate, which is nominalized since it's kind of dropped into 2022. I still think it's a reasonable company. I don't touch it because it tends to, trade at higher premiums to U.S. tech companies where I'd prefer to invest. But let's take a look at a few more. Brookfield Corp, if we take a look at this one here, this one I don't really understand. So again, you have to take into consideration that Brookfield is a huge asset management company, and this again comes back to the price to book value, which I find really intriguing because a lot of these companies you can't base off historical metrics, because I'm not sure how this company generates revenue. It could be through the sale of assets. I'm not quite sure because you can see there are constant major volatility spikes and swings. So kind of like I'm not sure what I could compare this to, but you can't really trust the earnings, right? Because the stock price has gone up regardless of the earnings, which again swung dramatically. So trading at 172 PE, can't really trust it here, but that does bake into the valuations that we saw in the overarching VCE ETF. Canadian Pacific Kansas City, one of the best performing railways that has been trending down along with Canadian National Railway. It's kind of crazy here. I think these things typically have been quite resilient. They're defined as recession proof because the railways are quite an undisruptible business. And if we take a look, their earnings have basically flatlined since about 2021, yet their valuations have continued to go up. So this is quite concerning considering before the pandemic, you could have got this between an 18 and 20 PE. And as of late, it's trading at quite high multiples not seen since basically the earlier 2010 era. So it'll be neat to see what happens here and if they can bring back earnings growth on the back of interest rate cuts. Lastly, Canadian Natural Resources. Again, all of these are Canada's largest companies. Trading at a price to earnings right now of 14 might sound great, but you have to have growth to even justify the current value. Now, 14 PE seems reasonable, but you have to keep in mind that if the company isn't growing or it's stagnating or prices going down, you could actually be paying a higher premium for this price to earnings multiple. And when oil is coming down, which we can see, their earnings are kind of dropping in line exactly with that oil price. It's almost like a direct comparable how oil's been dropping since 2022 to where it sits today. So, if we look back, and it's really hard to see, so let's zoom in a little bit just to get a more accurate description. We can see the price to earnings is actually materially higher than where it was when it was trading at anywhere from a 5 to a 10. If you go back not even that far, I think this is into maybe 2021 time period. So you want to keep that in mind, that this company was trading for much more favorable values, and it's likely the stock could keep going down and multiples could keep going up if the stock doesn't see any kind of earnings growth, which is unlikely to, as oil tends to level off here. So do keep that in mind when you're looking at a lot of these companies, because these price to earnings can be a bit deceptive. But that's the Canadian economy, the Canadian market. As we head toward earnings, we need to see how all of this turns out. But we can see that on the historical averages, these companies are materially higher than where they used to be. And I don't know if this is just because the Canadian dollar is rallying back, which means money's coming back to this economy, probably leaving the United States on the back of Trump's tariff war, which is great, bolstering our economy again. But at the same time, it is leading to some quite overvaluations. And regardless about how you feel about politics, it doesn't stop me from cost averaging into where I think the best companies are. Everyone's arguing and throwing tomatoes at each other, it seems like, and they're basically two parties of the same bird, or as they describe, two wings of the same bird. People get overly, I think, heated into politics, and I don't know when we started trusting politicians as much as we did. But yeah, I don't know. Like I said, I'm not as heated as some of these people are, and I just like believing in great companies. For example, like Take-Two Interactive, which is hitting all-time highs today, really removing some of the volatility from my stocks. S&P's up, even SCHD's starting to rally back here. A lot of my companies are doing great as earnings are here and starting to justify some of the valuations, as we saw with Google. I'm excited for Meta, Microsoft. The S&P is not cheap by any metric, but if the earnings growth maintain, I'm not saying it's that expensive right now either on the recent correction that we've had. So what I'm just going to show you anecdotally, which I think is really interesting, is in the midst of this tariff war, Amazon will be, I think, the defining factor to what this actually looks like to the end consumer, as Amazon being an e-commerce company where over 60% of the products sold are from people like you and me that use Amazon as the primary warehousing, shipping, and distribution center. And Amazon recently decided that they were going to show how much these tariffs were costing on individual products. And boy, did the administration not like that. If you guys didn't see it, let me share with you the funniest clip I've seen all week.
Mr. Secretary, so it was reported this morning that Amazon will soon display a little number next to the price of each product that shows how much the Trump tariffs are adding to the cost of each product. So isn't that a perfect, crystal clear demonstration that it's the American consumer and not China who is going to have to pay?
Yeah, no shoot, Sherlock. I mean, yeah, obviously the end consumer is the one paying that tax on tariffs.
For these policies?
I will take this, since I just got off the phone with the president about Amazon's announcement. This is a hostile and political act by Amazon. Why didn't Amazon do this when the Biden administration hiked inflation to the highest level in 40 years? And I would also add that It's not a surprise because, as Reuters recently wrote, Amazon has partnered with a Chinese propaganda arm. So this is another reason why Americans should buy American. It's another reason why we are onshoring critical supply chains here at home to.
This is like the biggest form of propaganda I've ever seen out of any U.S. administration. When you're like, why would they show the inflationary prices of the because that was a pandemic. It was a once in a generation like event that caused mass printing of dollars to bail out an entire economy from collapsing, because that's what would have happened to probably the entire services sector, right? So you got to understand that regardless of where you live and you're complaining about price inflation, housing, all this stuff, it is a global problem. You'll hear the same thing in Europe. You'll hear the same thing in Japan, same thing in the US and Canada. And it's all caused by that event. We're still reeling from the pandemic. It was it was like 2008. It takes time for us to get through the ebb and flow of the inflationary cycle that was caused by that. And I don't think it had anything to do with necessarily Joe Biden. And why would you put prices next to being like what it used to cost, what it costs now because of inflation, and leaving it? What makes more sense is, hey, you're buying these products that are coming from overseas and they're going to be getting a large tax, and here's the tax increase you're going to pay. And if anything, that's a good thing, because it would make you think maybe I can find a US counterpart to this product and buy it. So I don't know why the administration is hounding Amazon over this. I think it's almost laughable, and Amazon is considerably cheap today. And the reason I can say that is they don't make a huge material amount of money from their e-commerce sectors in anyways. It's been a huge money losing business for them, and most of their bottom line earnings have been bolstered by their cloud data centers. And I think that's going to continue to be the case. And if it is, and they're able to get through some of this shipping volatility and what it's going to impact on the e-commerce side, it could be considerably cheap for the growth that we've been experiencing at Amazon. I know it's trading at a 33 times multiple, but if you take a look at Amazon's revenue today, I'm gonna pull it up on, say, Macro Trends as an example, and I don't want you to look at necessarily the revenue, because I think it's a bit deceptive. To say Amazon brings in 630 billion is a bit of a joke. It's like the bank saying, oh, look, we have $1 trillion in assets, but really it's our money that you're holding. You're calling an asset, just like Amazon saying, oh, look, somebody bought a product on our website, but really they're buying it from me and you're just hosting it, but you're counting those dollars that I'm sending to the end user as your money, which again, isn't that accurate. And even still, for a company to be growing at 11% at 600 billion just shows the resilience of the e-commerce space and how we haven't peaked e-commerce from brick and mortar, still transitioning to this sector. And if you look at net income here, net income growth has been at the double-digit pace as of recently, and I'm not sure what exactly underlying has been really pushing this, and we'll find out on the recent earnings if a lot of that has been coming from a split perhaps of cloud and the e-commerce side. But if most of it's been purely cloud and this number keeps shooting up, Amazon is materially cheap as it stands today. Keep in mind though, this isn't a company that's really good at buying shares back. It's why I prefer Google over Amazon, but still, for the growth you're getting, if you believe in this company, maybe a little bit more risk now that the administration is attacking them. Most propaganda I've ever seen, the fact that they're starting to attack their own mega cap businesses that are just saying, hey, consumer, you're going to be paying a lot more on this product. And I think as a consumer, I would go look somewhere else. I don't know really why she would do this. It's kind of crazy to me, but maybe maybe I'm just a fool. Let me know what you think in that comment section below.